Well, good afternoon. Good afternoon and welcome to another Webinar Wednesday hosted by CSU Bakersfield Small Business Development Center. This is webinar number 276 in our series going back about 10 and a half years now. It is May 17th, and we got, I think, a very special guest today in Dr. Mark Evans, emeritus professor at CSUB. We'll be talking a lot about what's going on in the economy and what's going on with Dr. Evans. But first, so what is up today? Today, May 17th, 2023. Well, we have under our economic corner section of this webinar, we're going to be introducing what we're going to call as our resident economist. Yes, we've secured a deal for a resident economist. No more freelancing from me. Well, a little bit. I will be doing the freelancing when the resident is out, but we will have a resident economist to guide us through all this economic change and turmoil and issues and everything that changes so rapidly. So a little less of the freelance economic forecasting from me. Today, we bring in our resident economist, and we'll talk a little bit about that when we introduce Dr. Mark Evans. So our storm disaster centers, we have centers in Kern County that are closing. We have centers in Mono County that are opening. We'll talk a little bit about our capital corner today is about reducing your debt load. And I know we seem to talk a lot on this webinar about increasing your debt load, a variety of programs out there. Beyond the grant programs that don't increase your debt load, we oftentimes are talking about several of the different lending programs and going back to particularly the economic injury disaster loan, which of course is available for those that were impacted by the recent disasters in Kern County and throughout Central California. So let me talk about increasing your debt load for a second. But really, today it's about decreasing or reducing that debt load. So we'll take the flip side of things and look at some ways that you can, what you can do with your debt that you might already have, or ways that you can maybe add to it if maybe your debt solution is adding debt rather than reducing. Our community calendar this week, a little sparse, but not important, as the commencements are starting to happen around here in Bakersfield and Kern County. We're seeing not only the high schools and others that are going now, but CSUB, our CSUB grads, particularly those from our School of Business and Public Administration. A big heartfelt congratulations to you as you prepare for your next chapter in life and going through the commencement exercises later this week. So that's our community calendar for today. As always, we're going to take your questions because that's what we do. And also we'll have a poll. So we get Dr. Evans here. He might not be around the entire hour. So do go to the Q&A box and put in any particular questions you might have. Resources for today's webinar will be dropped into the chat box, as is normally the course. And so again, use the Q&A. We'll hit the Q&A after Dr. Evans's presentation and also the chat. So let's hit the poll now that you know where we're going today. And the first poll question that we have, and actually our only poll question, was going to ask you a little bit about how you feel about your current debt load. Do you want to increase it? Do you want to decrease it? Do you want to keep it the same? Well, you keep that in mind, and I will launch our only question today, and it's going to be on what is the average amount of debt carried by a small business owner? Is that $73,000, $195,000, or $280,000? So we're looking at the average debt, and debt is not a bad thing in business as long as it's manageable. You have good terms, you have a plan to repay it. You're doing your cash flow forecasting. But what we're asking is for you, what do you think is the average of debt of small businesses? 73%, 195, or 73,000, 195,000, or 280. So give you one last moment to jump in and answer today's poll question. It's got a nice hearty response. Thank you, the 71% of you that have participated in this poll. We are going to close it right now, ending the poll and sharing the results with you. 53% of you say it's $195,000, and you are correct. Congratulations, and you're not even a graduate. Way to go. So yes, the average debt carried by a small business owner is $195,000. 33% of you thought it might be $73,000, and 13%, $280,000. So thank you, and we will use that in the portion of our program after Dr. Evans comes on. So moving right along now, what we will do is continue, and we're going to move to a little bit of our economic quarter, and we have our resident economist in the house, just to remind you. But first of all, let's do this. Let's get to there and talk about our recap of some of the programs that are available with the related disaster. Just a few things that are going on. There is still assistance through a variety of federal agencies, and here's the 5 agencies that are offering one way, shape, or form of support. It is FEMA, the Federal Emergency Management Agency, the SBA, the Small Business Administration, through their Office of Disaster Assistance, USDA, of course, United States Department of Agriculture, through their Rural Development, and also we learned last week through their farmers, their FSA, the FSA agency as part of USDA. They are offering production agricultural things in addition to what Rural Development is offering. The Department of Treasury has extended tax deadlines in order to give people that are in disaster areas, which is a lot of Central California, Kern County included, more time to file their taxes. So you are not late if you did not file earlier this month. And there it is, the Farm Service Agency at the bottom. Yes, they have programs as well now. So we did mention that a couple of the disaster offices in Kern County, the one in Lake Isabella, in the Kern River Valley, and also in McFarland, USA, and both closed and opening. That is my understanding, but it doesn't mean the programs have closed. They will go on if you have suffered an economic injury until January of 2024. And there is still plenty of time. It's just as the crowd started waning down, they felt that their resources were better placed in other communities. And maybe they just jumped over the hill and went to Bridgeport and Mammoth Lakes. Disaster centers have been set up in those 2 communities in Mono County. And one of them opened yesterday, the Mammoth Lakes Center, which is located at the Mono County Civic Center, right over there on Tavern Road. Been there before, nice building. And also up in Bridgeport, lovely Bridgeport, California, at the Bridgeport Memorial Hall, right on School Street. So those are open 9 to 6 and operating Monday through Saturday. So we do realize that there were flooding, a lot of issues with the massive snowpack that was really going on and on in the Eastern Sierra for a long time. Some of that is melting now, and we're starting to see some of the disasters. So those areas are now open to assist our friends and businesses in Mono County. So there are the declarations that we have talked about, and a lot of the information is available on that. I'm not going to really go through much of that information at this time. We've talked a lot about it. The slide provides a lot of information, and really there are better resources than the slide, but it gives you an idea of some of the resources that are available as far as business loans and the economic injury disaster loans and some other things that can benefit homeowners. And some of those are USDA, and there's our contact for USDA. If you've had problems with your house, entrepreneurs, business owners, you all have homes too, and they could have been impacted rather than just your particular business. So we have the information available. Your timeline information for filing your tax returns is right there. And now I get to bring in our special guest. And I did mention that Dr. Evans will be joining us as our resident economist. So what does that mean before I give him his somewhat full and somewhat proper introduction? So he is going to be appearing in just kind of a pop-in, our live look-in, as we like to call it, that him and I both stole from the Major League Baseball Network. So our live look-in will be a guest when Dr. Evans pops in early in a webinar that will likely contain another speaker. But what he will do is he'll give us his 10 or 15 minutes or whatever on what is happening in the economy this particular period. We'll probably have him on twice a month. We're really excited to bring somebody of his stature and his value to the community, in both the business community, the economic community, and also the economic development community. So Dr. Evans was he is an emeritus professor for CSUB. He won't let me mention, but he was admitted into the CSUB Faculty Hall of Fame earlier this year. So I'm not going to say that because he asked me specifically not to. Oops, I just did. But he has served over 40 years at Cal State Bakersfield, going back to 1978. He's still very actively involved in his community. He works on longer term issues such as the B3K, the Better Bakersfield Bountiful Kern Initiative. Boy, that's hard for me to say. And has had a solid small business background, serving as a key advisory member for the Central California SBDC region, getting to know the ins and outs of small businesses, incorporating them with his vast economic knowledge. We're thrilled to have him as a semi-regular on Webinar Wednesday. Thank you, Dr. Evans. Thank you for that commitment. It's great to have you here. What's going on in the economy that we need to know about today?
Well, thank you for that nice introduction, Kelly. What I thought I would talk about today is, basically a couple of, where we are in terms of our game plan in terms of disinflation or reducing the inflation rate in the economy, and where I think what I think the risks are, the headwinds going forward. So you may recall that I think I was on Webinar Wednesday about a year ago, and I outlined what the Federal Reserve's game plan was trying to accomplish, and the goals have not changed much. We'll take a look at what the progress report on achieving the goals, which you may recall that the goal is to reduce the inflation rate to that long-term target of 2 to 2.5%, and to do so without inducing a recession. And then the way the plan or the strategy is to increase interest rates, which should eventually slow GDP growth to less than 2% or so. So as long as GDP is growing, aggregate income in the economy is growing. And we're avoiding a recession. But at that slow of a growth rate, because of productivity growth as well as labor force growth, you will see a decrease in job openings and a gradual increase in the unemployment rate. And here there's a little bit of disagreement among the optimists and what I'll call the realists. The optimists would say that the slowdown does not have to really increase the unemployment rate very much. The realists, or the ones relying on past observations, think that probably that unemployment rate's going to have to, go higher by at least a point to maybe it takes about, inflation or unemployment rates above 4.5% or so for the wage price spiral to start winding downward. So either way, hopefully the optimists are right. I'm probably more of a realist, but that should lead to a reduction in wage increases, associated price markups, and then ultimately that should lead to inflation rate back down to the 2.5% level. So let's take a look at where we are in this process. And as all of you know, the federal funds rate, or the one rate that the Federal Reserve does control, kind of like a bank lending rate, bank to bank, it's gone from essentially zero or just slightly above zero to around 5% over the last year or so. So that's basically what triggers the whole game plan. And then let's take a look at what's been happening in terms of some key indicators. So here, GDP growth. What I've done here is I've tracked it basically quarter to the same quarter of the following year. So here for GDP growth, you can see that it has slowed. First quarter of 21 to first quarter of 22, GDP grew at 3.7%. And then second quarter to second quarter, 1.8, similar to third quarter. And then fourth quarter of 2021 to fourth quarter of 2022, you do see the slowdown, but then first quarter of 22 to first quarter of 23, what you see is it's bumped back up again. If you look just at fourth quarter of last year to first quarter of this year, and then annualize that growth rate over full year, you're at 1.1%. So you can see that the Fed seems to be doing a pretty good job of really reducing that GDP growth rate to a level that in the long run at least makes a soft landing possible. Okay, but then you look at the core inflation rate, the specific price index that the Fed likes to use to monitor inflation in the economy. And you can see that early 2021 inflation was running more than 6% based on their favored index. And then over the next year, it came down to 4.7%. But since the second quarter of 2022, we've really seen no further progress. So I think clearly what's happened here is that, those elements of inflation that were pandemic related we've gradually made those adjustments, and that part of the inflation is perhaps behind us, but there remains a kind of like a core that's very difficult to get rid of between 4 to 5%. And you can see why. Look at business sector unit costs. Second quarter 21 to second quarter 22, they were running at greater than 7% a year, and they've slowed, but they seem stuck at a little bit less than 6% on an annualized basis. So it's really not possible to continue reducing that core inflation rate with wage increases running at this level. And then you can see it actually see it in the inflation numbers that they're no longer declining. In terms of labor markets, I've looked at what's happened over the last year on a quarterly basis in Kern, California, and US. And the main thing that sticks out here is that the US unemployment rate is stuck at about 3.5%, which is wonderful, and that many people have jobs. But over the last year or so, in terms of quarterly averages, it's actually fallen. So it's at historically low levels. So what can we say about the game plan? They have increased interest rates that has slowed GDP growth, but it's had a tiny effect, but not enough effect on inflation because the economy is still running very strong, and you can see this in the labor market. So I think the headwinds going forward, I do not think the Fed wants to repeat the mistakes it made in the late 70s and 80s before Paul Volcker era, where basically they took the foot off the brake too soon and inflation accelerated again. So I think we are in a pause right now, in terms of them increasing the federal funds rate. We may see a meeting or so where they don't continue raising the rate, but I think the reality that's gradually setting in is if they're serious about this 2 to 2.5% target, and I think they are, there's still a lot of excess demand in the economy, and if they're going to reduce expected inflation and start making progress in terms of whittling down that wage price cycle, we can expect the slower growth to continue, GDP growth of 1% or less. And that may take, after a pause, some, again, increases in the federal funds rate and then all the interest rates that build off of that. So I think I am not optimistic, and I don't think the Fed is, that we've won the inflation fight. I think there's going to be continue clamping down on interest rates until you see more progress in terms of wage price settlements and this core inflation rate. And then, of course, the other headwind facing us is the debt default uncertainty. And almost anything can happen here, from a kind of a last minute deal that essentially would be a clean debt ceiling increase, at least until the 2024 fiscal year budget negotiations. And then we would align the debt ceiling negotiations with the actual budget, which is the way it should be, I think. Very little impact, I think, if in fact we can pull this off. The estimates are all over the place, but if there is a default and it's brief, the Council of Economic Advisors expects about 500,000 job loss in the third quarter, the unemployment rate to inch up about 0.3%, and real GDP to start declining by maybe 0.5% or so a year. If the default is protracted, you're going to get significant financial market disruption. You will get financial market disruption even if if it's a brief default. It'll be quite significant. The more protracted it gets, and what you're looking at in terms of the worst case scenario is a recession, kind of like the 2008 recession. So I think the economy is running very strong, but because bottom line is because inflation still is well above the targeted rate and the Fed's commitment to reducing it. I don't see interest rates backing off anytime soon. And then you combine that with a risk of default, and it's really a time where it's very uncertain and difficult to predict exactly what will happen because of we don't know how the debt negotiations will play out. And with that, any questions or comments you have, Kelly?
Oh, I have a question.
You always do.
I found the debt default, the brief debt default, fascinating from the standpoint that, is there, when we talk about what's been going on in the economy, it needs to slow down. And it seemed like what you showed on the slide for the brief debt default is what the Fed has been trying to accomplish over the last year, is to slow the economy enough, to slow inflation enough. And so could the direct, brief debt default actually be advantageous for longer term economic growth?
Well, it would definitely slow the economy, but if you look at the Fed projections about a year ago, I mean, I think I mentioned at the time when I was on about a year ago that they seemed unrealistic to me, and that they were projecting that inflation would come back down to the target range without unemployment increasing significantly. And so I guess I believe it's going to be necessary. I believe that it's the kind of thing that it's just too uncertain in terms of a way to bring it about. There's too many unhidden consequences if you go that route. But yeah, I think the idea that that the economy needs to slow down, and that would definitely pause it, has some validity, but I think it would overshoot probably.
Yeah, well, you didn't expect that question from me. So you did mention last time you were on, and I like to do, I like to go back and see, it's like businesses, you got to look at those historical results. So here's a couple of slides from when you were on almost a year ago in May of 2022. And I'll let you explain. I have two slides here that you provided then. And this one, I like the title of it, 2021 Missteps. And I assume that's by the Federal Reserve for allowing inflation to get out of control. But here are some of the numbers that I believe that they had. Can you explain a little more detail on this slide?
Okay, well, as I recall, the historical data here was actual data, and the 2022 first quarter was their forecast, as I recall.
I think it was just out because we were in May.
Yeah, so well, I think it basically confirms what's happened in that other than GDP has not slowed. It hasn't fallen by, it increased by 1.1% annual, well, the second quarter. Okay, at least in terms of all of 2022, it just continued, GDP continued increasing, although at roughly less than 2%. The unemployment rate, yeah, it's around 3.5. So again, this was first quarter. It hasn't moved much. And the inflation rate has gone down, but I think that's just the pandemic element of it. And there's still the excess demand and the wage price cycle aspect of it that's still with us.
Yeah, this next slide shows their forecast for soft landing. And you know me, if you're going to have a landing, a soft landing is preferred.
Yeah, I've been on several where I can testify that soft landings are preferred. Yeah, and here again, I think what stuck out when I saw this is really cognitive dissonance. Is what the FOMC was suggesting back then is that if they held the unemployment rate to 3.5%, they could bring the inflation rate down. From core 4.3 to down toward the 2% target, and it's actually running about 4.7% now. Now, what most economists will, or standard economic theory says there's an unemployment rate trigger where, if the unemployment rate is below 4.4, 4.5%, and this varies over time and it's hard to estimate, that you're going to have trouble trying to wind down the inflation rate. And that's where we are, and we are having trouble winding down the inflation rate.
Okay, great. So just so everybody knows, FOMC stands for the Fed Open Market Committee.
Yeah, and they are the people that run monetary policy. It's a very small group composed of a subset of the Fed presidents, and they each have a support staff of professional economists.
Okay. Well, they definitely got to sharpen their pencil because those numbers aren't realistic of what we finished up with in 2022. At least some of them, mainly inflation and maybe growth. But
yeah, so here I was questioning whether it was reasonable to assume that inflation rate's going to decrease, and with the unemployment rate staying and the economy still running so strong, and unemployment in the 3.5 range. And sure enough, I think it looks like they were too optimistic, that they could disinflate partially, but only because a lot of it was temporary inflation caused by pandemic issues. But once those issues are resolved, there's the underlying fundamentals that you're not going to touch with the labor markets running this hot. There's well more than, I think, almost 2, not quite 2 job openings now for every person unemployed. That's very strong historically.
Okay, we got a question for you, Doctor.
Okay.
Can you tell us about the state of the commercial credit default swaps and the state of the Fed balance sheet with respect to how likely that soft landing will be? How will the dollar, the second part of the question would be, how will the dollar loosening its global dominance impact our soft landing?
Well, if the dollar weakens from a business cycle perspective, it just stimulates exports. So it works in terms of accelerating the economy. I think the bigger problem there is with the default, just our psychological position globally with respect to dollar being an international currency, as well as just our, in terms of international relations, our bargaining power and everything. There's just a long run undermining of those that's probably more important than all these short run business cycle guesses about what's going to happen to the unemployment rate and inflation rate and GDP growth. So yeah, I think an even bigger issue is our credibility in the world. So we definitely want to get through this thing without defaulting for that reason.
Next question, Doctor, is if we do see an economic slowdown, which small business sectors do you expect to get hit the hardest? And do you see any benefiting? I'll let you think about that. And let me just jump in and say what I would think. I think it's going to, we've really seen kind of a revitalization in the hospitality industries, particularly dining out and travel. It seems like when you do have an economic slowdown, the small businesses that get hit the hardest are those that are the ones that have or use discretionary funds from business to business, business to consumer. So it's the consumer spending that generally will result in hospitality businesses that I see anyway from my role here. What do you see, Doctor?
Yeah, I think durable goods in terms of manufacturers, but in terms of small businesses, I think businesses that sell fairly expensive durable goods, as well as services that are discretionary.
I think you're going
to you can postpone buying a car, just keeping it one more year, the one you have. You can postpone that nice vacation, that trip. So yeah, maybe upscale restaurants.
It's a good time to have business and government customers when consumers start spending less. Okay, Doctor, that wraps it for today. You get a little longer dose today than you'll get later on, but it's great to have you as our resident economist. We look forward to having you on a couple of times a month. Pop in. Feel free to talk about what you want to talk about. That's what we want. You could talk about the economy. You could talk about locally some policy changes that you see affecting the economy, small business. It's your gig. Do what you want to do.
Oh, I appreciate the opportunity, and talk to you soon.
Thank you, Dr. Mark Evans. So thank you, Dr. Evans. Look forward to having you with us. Let's talk a little bit now about some of the debt strategies. And as I had mentioned earlier, we had talked a lot in the last couple of years about increasing your debt. So now we want to kind of look at, if we're going into an economic slowdown or some other issue, what can you do? What strategies can you implement in order to either reduce or manage your debt better? So number one, from my standpoint, it really comes down to understanding your debt load. And what I mean by that is understanding basically what you have as far as some of your terms and conditions of the debt. You know, every loan seems to be different. If you bring in with different terms, so there'll be some are tied to different variable rates. Your debt schedule would want to then include what schedule of debt that you actually have. It could be a hodgepodge. I love the word hodgepodge. You could have, for example, an EIDL, a microloan. Maybe you have a note from a family member. Maybe it's a fintech deal, but a simple schedule that shows the amount that you owe, the interest rate that is owed, the amount of the payment, if there's any prepayment penalty, and other things that will change if, for example, you have a variable note. So really understanding where your debt schedule is and how a lot of the economic terms that Dr. Evans talked about affect, especially the increasing interest rates, how they affect your debt. And that is easy to do by understanding your debt, by knowing your terms, and by constructing a debt schedule. So then when you have your debt schedule, the tool that I really like to implement, and we've used, I won't go over it today because of time, but it's your average cost of capital. So it is taking the amount of your indebtedness times the interest rate and understanding what your average cost of capital is. So moving forward, what does that mean? Well, if I have, say those, let's say those 4 loans above, the capital, you know, the EIDL, the microloan, the family loan, the fintech deal, my EIDL loan could be at 3.75%, whereas my fintech deal, as we've talked about in past weeks, could be at 51%. So really averaging based on the amount of the debt you have times the interest rate will give you an average cost of capital. So you could literally have a interest rate that goes from 3.75 to 51% in your collection of debt. So this just identifies the average cost of that debt. And then if you don't know for sure, you know, some of the APR, the annual percentage rate tools that we used in the past to come up with 2 of the 3 factors that determine what is the interest rate you pay, the amount of the debt, also the term and the conditions of repayment can then show you what that interest rate is. And an APR tool is perfect for that. So number 1 on our list is to understand your debt load. So we're understanding our debt load. So now, hey, let's get a plan. And, you know, our plan could be to add debt. Our plan could be that maybe for reducing debt, it's to add debt. No, but to actually grow the business, it could be to add debt. And there are ways to do that. One of them would be by acquiring other debt and by expanding your business by acquisition. So a little known strategy for reducing debt where you actually take on more debt could increase the profitability in order to pay off debt, could be acquiring another business. So that is an interesting aspect. I think more frequently, your debt plan will have ways to reduce your debt and also ways of consolidating your debt. Now, if you've been on Webinar Wednesday, you know I'm a real fan of the cash flow forecast and being able to forecast your cash flow needs and maybe even cash flow in an extra or even a larger payment for your particular debt. Where does that come from? Could come from increased sales, reduced cost, etc. But really understanding where your cash flow forecast is and how it works. And there's just our basic model that we have used over time. And the cash flow forecast just essentially, this is an Excel spreadsheet. We do have examples of them filled out. In the interest of time today, we will not go through those, but there is the cash flow forecast. It is a little dated, as I see, but if you start, say, doing this in the month of June, so what we would do is go to the middle of the forecast and go under June, and we'd look at your cash balance that you have in the business, and it could be from a checking account in the business, it could be from other bank accounts, but the collection of those accounts that you have are basically the cash that's available to you on June 1st. Then If you look at the cash receipts section, you can add the cash that's available, the cash sales that you have or forecast for your business. Your cash on credit is going to depend on your terms. So whereas cash sales and ATM sales or debit sales are open to you and available either that day or the next, in most cases, those would occur in that particular month. But if you have a sale on credit that has a term of 30 days, that money isn't going to come in until July. So if you do have terms, you have to reflect your terms for the amount of leeway that you give your customers. So assuming a net 30 policy would bring that money in July, even though the sale is in June. If you have net 90, that would bring that sale in September and you would account for it then. So then, any other loan or injection that you have in your particular business, maybe you have investors that invest in your particular project. You have a line of credit or other means of adding to your receipts, your cash receipts in that given month. So that is June. And then we go into the dreaded cash payments. So it is a cash budget, essentially. It's budgeting your terms and going through all of those particular cash payments, adding those up to determine your cash position. And then at the end of June, our cash position moves to July and we start all over again. So a simple way for you to determine what your cash needs are going to be and how can we reduce debt with this one single piece of paper, this one single Excel spreadsheet. And that is going down to the bottom part of 5 and going into particular areas like our principal payment and also interest payments that are here, and trying to increase those if it doesn't trigger any type of prepayment penalty from our terms of our loan. So a wonderful tool. The great thing about this, I like to say it's our artificial intelligence tool that we have at this time, because the longer that you do it, the more that you learn and actually know about your business and how your expenses are going to fly. And it works great for seasonal businesses. So if you have a tremendous seasonal aspect, a winter or summer term to that, you can really account for when money is going to come in more heavily during those better periods, and then account for less cash during those moments when it doesn't happen. Okay, I like to call this the duh answer for reducing debt, and it's pretty much cutting back on expenses and increasing revenues. I think the fun part of this, the opportunity lies really more creatively anyway, in increasing revenues. So a lot of times you'll see people, they'll cut back on their marketing expenses, on cutting back on expenses. And what that does is has an effect on your revenues. So there's that real balance between actually increasing revenues and cutting back on expenses, and what expenses to cut back on, which is the critical factor in all of this. But it's the duh answer. It's duh. I need to cut back on expenses so I can pay down more debt. I need to increase more revenues so I increase more profit, and then therefore be able to have more cash available to pay off that debt. Okay, our last strategy for decreasing debt is going to be consolidation. And at the SBDC, and I'm sure our friends at other SBDCs get the same request oftentimes, where we will get people that come in with those 51% tech loans, those online loans. And, we don't judge, we know you might need that money at that time. The first thing that you do not want to do with a 51% loan from a fintech company is what? You don't want to repay it early. There is not a prepayment penalty, but that 51% in most cases, that's why you need to understand your debt terms, in most cases goes for the term of that loan. So it goes for the 18 months or the 24 months, or in limited cases, a 3-year, 36-month term. So if you are actually paying the amount that equals 51% over a 3-year term, the last thing you want to do is pay it off in 1 year, because you've increased your APR. It's no longer 51%. But also what you've done is you have increased your APR And you've also basically could have used that for 2 years of additional money for no charge. So when you do get into those higher deals, you've got to look at your debt terms. And oftentimes, whereas it's really the intuitive answer to this is you want to pay off. And we've always wanted to pay off higher debt, higher cost of capital sooner. This is the one instance it's counterintuitive. Don't do it. Let it go its term. Understand that that's the amount that you're paying for that debt. If you signed on to it, most likely there was a critical need for it, or you didn't understand the exact amount of the annual percentage rate because it's not listed. Oftentimes you will have the payment that's taken out on a daily basis for whatever your term is. In our case, let's go 3 years, or maybe it's taken out weekly. And then you also have the amount that's taken out, but you don't have a factor or an interest rate that shows what that charge is unless you use an APR tool. Okay. So then we come to my secret for consolidating debt. And I gave you an off-the-wall suggestion of by growing. Well, I actually kind of like that one. The problem when we have a lot of people that come to the SBDC and say, I have this 51% rate, I have this other loan, I want to consolidate this and get something manageable. So let's say you have those 4 loans that we talked about earlier, going from an idle at 3.75%, which you do not want to pay off. You want to pay it down over the length of the loan, 30 years, gracious terms, best terms you'll ever get. So you might want to consolidate your other 3 loans, and you find out that by those 3, the average cost of your capital is 22%. And you're going, wow, I could have almost used a credit card for that. And maybe. So what do you do with that remaining 22%? Because you're saying maybe I can get something in the 8 to 12% range. Nowadays, maybe 12 to 13% that would reduce the interest on my debt and actually give me more of an opportunity to pay it off. Well, my biggest secret for trying to do that, for trying to consolidate, is to actually be able to demonstrate to the borrower, or excuse me, to the lender, you being the borrower, demonstrate to the lender that part of that is going to go for growth. Lenders do like consolidating, but they don't like taking on other people's debt. So if you've accumulated other debt and you don't have an opportunity to grow, it's a very difficult challenge for a lender to make that particular loan. Even at 12 or 13% to consolidate, and you can show interest savings over where it could save you $20,000, maybe $25,000 a year in interest. It's still, if you're lacking a growth component, if you're lacking a longer term growth strategy to where you're saying, I need to consolidate this debt because I need another $20,000 in addition to grow this particular business and get it to this level based on my financial projections and my cash flow forecast, then that is the secret for consolidating debt. Okay. Any questions? I'll take them in the Q&A box. Okay, so that is essentially reducing debt, kind of winding things down before I run out of time here. Winding things down. The other thing on consolidation of debt is, this is a slide from a colleague of ours up in the Northern California, gentleman named Mr. Rogowski. I'll give him his props. And he's under the assumption that there is money for everybody. And there is, I think, a truth to that, a certain truth. And this lists all the alternative funds and all the alternative sources of funding. Some of those are very creative and get into ways of strategic partnering. And oftentimes, a lot of these are ones that when our typical clients at an SBDC will look at, they'll say, oh, gee, there's not a lot of them on here that I really want to do. And we've even included in here the online lending sources, the fintech, because there could be a sense of where 51% at 18 months is worth doing. Most cases, definitely not. But in certain situations where you're able to acquire potentially an asset or other resource, it could be worth doing. So, and then also the owner financing that I had mentioned earlier about potentially growing through actually having an owner who is the bank that takes on additional debt if you're able to add profitability and reduce other debt. Okay, so there it is, a long list of alternative sources that are available. Our SBDC toolbox, we just added our resident economist right under the Clayton Leadership Transition Plan, a great plan for transitioning ownership and leadership for a business to a next generation. Our YouTube channel is there, a live plan, cash flow forecast has been there for a while. But our new tool to the toolbox now is Dr. Evans and our resident economist. Again, there it is, that cash flow forecast. Also a resource if you have any HR questions throughout Central California, America's Job Center, a hotline provided by the California Employer Association. There's your 800 number, and the hotline hour is open 8 to 5 Monday through Friday. So if you have questions on, human resources, complimentary human resource consulting, get another view, get 2 views for that matter on a particular subject. It doesn't hurt. So a free hotline, 888-201-7101. There's our YouTube channel. Please frequent our YouTube channel. This video will be a part of that channel in just a couple of days afterwards, the YouTube channel, and we will be coming back next week with webinar number 276. It won't be May 17th next week, though. It'll be May 24th. And it may not be webinar 276, but anyway, we'll be back. So let me hit a couple of questions here real quick while I throw up an erroneous slide. Do you have any recommendations for first-time debt? We are opening a new tutorial business, and everything has been paid out of pocket so far, but we could use extra assistance. Great question. So first-time debt, startup debt is going to be the most hardest to find, but I think it is easier than it has been. A lot of the resources that you think that are going to provide you first-time debt are not going to probably be available. What it's going to do is you're going to need to show and demonstrate a variety of different factors. You're going to be getting a loan based on a projected basis if you're able to get one. Oftentimes, CDFIs, community development financial institutions, and we have 3 of those operating in Kern County now, with a shout out and a congratulations to Valley Strong Credit Union, who just received notification that they will be our next CDFI. But CDFIs are essentially nonprofits or functions of savings and loans, as we used to call them, credit unions, that actually will provide, other types of easier funds than bank funds. Usually banks are not really geared towards startup funding. Their business models are to help businesses grow and to be there for that next step of the ride. So the recommendation would be to talk to an SBDC consultant, see what maybe nonprofit lenders are out there. What you're going to need is you're going to probably need, a pretty decent looking little balance sheet. And then by that, I just mean the fact that you've already put in some money as far as capital into that business, which you have mentioned. They'll look for also a clean credit. They'll look for, or cleaner credit, I should say, not absolutely perfect credit required. So they're going to look for a variety of things. They're going to look for you to be providing some capital injection, what you're doing. They're going to be looking for, the credit, and they're going to look for the character of the business. They're going to be looking on paper that you have a business plan with financial projections. And then you're going to be able to have to sell that. You're going to have to sell the business plan, the projections on how that would particularly work and how your business will make money. So those are the best suggestions I have. Oftentimes those loans will need to be secured or collateralized. And so for some businesses where you're not actually using the money to buy assets that can be used for security, oftentimes that'll have to come from a secondary source or maybe some personal assets. As far as capital into the business, you've put in cash, you might have put in other assets. Being a tutoring business, you might have had a network of computers and other, maybe intellectual properties that you've actually contributed. There could be desks, there could be other things that were your own that have a value as being contributed as capital, but oftentimes they need to see you come in with cash. And it is easier to get first-time capital now than it has been anytime, I think, in the last 10 years. So I believe that's it. One last check of the chat to see what we have in there. Maureen, our webinar producer, Maureen Busher-Dang, what a great job she does. Besides just her greeting, she put information about the disaster resource centers in Mammoth Lakes and Bridgeport. Also some of the USDA information and other information that is out there as far as things that we can do to assist you. She also threw in our Google reviews. So if you've had a positive experience today, please go to our CSUB business profile on Google and leave a favorable review, and encourage people in your businesses to do it as well. Okay, that is going to wrap it up. We are done with number 276. We will be back next week with 277. And for Dr. Mark Evans, our producer, Maureen Busher-Dang, I'm Kelly Bearden. Everybody have a great week. Goodbye, everybody.